It's late, you're half asleep, and you open the app to check your retirement account. There's the little green number at the bottom, and there's that quiet hit of, okay, I'm doing this right. That number might be the most comforting assumption in your financial life, because the scariest forecast on Wall Street isn't a crash. It's a single quiet number that slid past you. 3%. That's the annualized return Goldman Sachs calculates we're stuck with for this decade. We are already 2 years into that forecast, and for those counting on a massive recovery, the clock is ticking. Not 3% plus inflation. 3% period, which after inflation is basically zero. And the same bank publishing that is telling you to stay fully invested and trust the market. Same firm, same month. Somebody's getting the real memo and somebody's getting the brochure. My name is Nick, and I read these reports so you don't have to. This isn't a video about a crash. It's about the slow, silent decade that does more damage than any crash, and why the index fund you think is keeping you safe might be the single most exposed thing you own. So let's actually sit with that number for a second, because 3% a year doesn't sound scary. It sounds fine. It sounds like a savings account that's trying its best, but 3% before inflation over 10 years on a market that most people are counting on to fund their entire retirement is the financial equivalent of running on a treadmill and calling it a road trip. You're moving, you're sweating, you are going absolutely nowhere. And to be clear, this isn't some guy in a gold bug newsletter screaming about the end of the world. This is the most mainstream institution on the planet, Goldman Sachs, the bank your bank's bank uses, and they are not alone. Meet two people who are going to follow us through this whole video. First, there's Daniel. Daniel is 57. He's doing everything right, but he's now less than 8 years from his target retirement date. For him, a lost decade isn't a theoretical risk, it's a retirement killer. Then there's Catherine. Catherine is 28, just opened her first brokerage account. And when a survey asked her what return she expects from stocks, she said confidently 10% a year, maybe 12. Hold on to both of them, because by the end of this, the gap between what Daniel and Catherine believe and what Wall Street is quietly forecasting is going to be the whole ball game. Back in late 2024, Goldman Sachs issued a landmark forecast that most people ignored. They estimated that for the decade leading into the mid-2030s, the S&P 500 would deliver an annualized return of just 3%. And then they go further, and this is the line that should stop you cold. They put a 72% probability that stocks will simply underperform bonds over that stretch. Boring, safe, government bonds. They put a 1 in 3 chance that stocks don't even beat inflation. The biggest investment bank in America ran the numbers and concluded there's a 1 in 3 chance the stock market loses to a loaf of bread over the next decade. Goldman isn't the only firm expecting more modest returns. Several major investment firms, including Vanguard and JP Morgan, have projected future U.S. stock returns that are well below the market's long-term historical average. But here's the tell. Even the optimists on Wall Street are forecasting returns far below the 10% a year the market has averaged for the last century, and far below what people like Catherine are penciling in. And then there's Warren Buffett, who doesn't write research notes, he just acts. And what did Warren Buffett do while markets kept climbing? Berkshire Hathaway accumulated one of the largest cash positions in its history, giving the company enormous flexibility if opportunities appear. So that's the warning. Now let me show you the evidence, because a forecast is just an opinion until you see what it's built on. And what it's built on is the price tag. There's a number called the CAPE ratio. Think of it as the market's price tag, adjusted so you can compare today to any moment in history. The long run average is around 17. Even now, the CAPE ratio remains stuck in territory that has historically preceded lost decades. We are paying prices that usually only make sense if the economy grows at a rate that simply isn't happening and remains near levels that have historically been associated with lower long-term returns. The closest modern comparison is the dot-com bubble era, when valuations reached similarly extreme territory. The broader point isn't that a crash is guaranteed. It's that when investors pay unusually high prices for stocks, future returns have historically tended to be lower than average. There's another gauge Buffett himself made famous, so famous it's literally called the Buffett indicator. Historically, readings around 100% were considered expensive. Today, the indicator remains well above its long-term average and continues to suggest the market is priced at a historically rich valuation relative to the economy. In other words, the stock market remains expensive relative to the size of the economy by historical standards. Now, here's why this matters, and it's the most important idea in this section. High starting prices don't just feel uncomfortable. Historically, they've been one of the strongest indicators of lower future returns. Look back over a century of data, and one of the strongest predictors of long-term market returns isn't the news, isn't the Fed, isn't who's president. It's simply how expensive stocks were the day you bought them. Buy cheap, you tend to do great. Buy this expensive. History says you get a decade that looks a lot like that, boring 3%. Goldman didn't pull that number out of a hat. They pulled it off the price tag. And let me make that boring 3% concrete, because percentages don't scare anyone until you put a dollar sign in front of them. Say you've got $100,000 invested today. At the 10% a year people like Catherine expect, in 10 years that grows to about $259,000. At the 7% that's been the long run normal, it's about $197,000. At Goldman's 3%, about $134,000. That's a $62,000 gap between the normal you're casually assuming and the future Wall Street is actually modeling. And that's on just 100 grand. Scale it up to a real retirement balance and you're not missing a nicer vacation. You're missing years of your life you'd planned to spend not working. So before this stays theoretical, open that app again, look at your actual balance, and run it forward at 3 instead of 10. That gap you just felt is the whole video. But here's where it gets personal, because so far this could just sound like macro noise, the kind of thing that doesn't touch your actual life. So let me tell you about the thing hiding inside Daniel's perfect, responsible, did everything right index fund. The thing he has absolutely no idea is in there. Daniel thinks he owns 500 companies. That's the whole pitch of an S&P 500 fund, right? You're diversified. You own a tiny slice of corporate America, spread across 500 different businesses, so no single one can sink you, except that's not really what Daniel owns anymore. Since the post-2024 surge, we've seen a level of concentration never before seen in history. That same handful of tech giants, the ones we call the Magnificent Seven, still account for a massive chunk of the index, meaning Daniel's diversified fund is still just a bet on a few CEOs in Silicon Valley. 7. Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla. They even have a nickname, the Magnificent Seven, which sounds heroic until you realize it means Daniel has roughly a third of his life savings riding on 7 stocks that all do basically the same handful of things and all tend to move together. Stretch it to the 10 largest companies, and you're looking at an enormous share of the index concentrated in a very small number of names. Nvidia alone has grown into one of the largest positions in the entire index. That's remarkable for a fund that many investors think of as broadly diversified. And here's the kicker. During some of the market's strongest recent years, those 7 companies were responsible for an outsized share of the index's gains. So when you tell people the market had a great year, what you're mostly saying is 7 stocks had a great year and dragged the other 493 along like a group project. And this isn't just Daniel's problem. If you own a standard index fund, it's yours too. The thing you picked precisely because it sounded boring and safe is, under the hood, one of the most concentrated bets retail investors have ever quietly made. So in reality, the performance of his retirement is being decided by a tiny cluster of AI chip and cloud stocks trading at some of the richest valuations in market history. He didn't choose that. Nobody sent him a memo. The index just quietly concentrated underneath him while he was busy doing everything right. And we've already seen what happens when this cluster wobbles. We saw this in 2022, and we've seen the same volatility through 25. The names that carry you up the mountain are the exact same names that drop you twice as fast when the wind changes. Those same big tech names didn't fall 20, they fell roughly 40, twice as hard. The thing carrying you up the mountain is the same thing that drops you twice as fast on the way down. That's not diversification. That's a bet wearing a diversification costume. Now, you might be thinking, okay, Nick, but those are incredible companies. Apple, Nvidia, these are the best businesses in the world. And you're right. That's exactly what makes this trap so good. Hold that thought, because the bull case genuinely deserves a fair hearing, and I'm going to give it one, but first I have to show you the gap. The reason this whole video is called You're Not Ready. Remember Catherine expecting 10, maybe 12% a year? She's not unusual. She's the average. When the firm Natixis surveyed American investors, they found everyday investors expected long-term returns of more than 15% a year above inflation. Meanwhile, the financial advisors those same people pay for advice said something closer to 7% was realistic. That's not a small disagreement. That's investors expecting more than double what the professionals managing their money think is even possible. And it's more than triple what Goldman is forecasting. So picture the collision. You've got a whole generation of Catherines planning their future around 10, 12, 15%. You've got Wall Street's own models whispering 3. And in between those two numbers lives every retirement plan that's quietly about to come up short. That's what the title of this video actually means. You're Not Ready isn't about a crash you'll see coming. It's about a decade you'll spend assuming you're on track, doing everything right, while the math quietly disagrees the entire time. Daniel isn't ready, Catherine isn't ready, and if you've never run your real number at 3%, neither are you. Yet. And there's a second sneakier problem. Even the returns the market does deliver, most people don't actually capture. A research firm called Dalbar tracks this every year, and the finding is brutally consistent. The average investor earns meaningfully less than the very funds they own. Not because the funds are bad, but because people buy high when they're excited and sell low when they're scared over and over. The fund does fine. The human holding it panics at the worst possible moment and leaves money on the table every time. Now layer that onto Daniel and you get the part that genuinely keeps me up at night. Because Daniel has a very specific picture in his head. A small place near the water, a paid-off truck in the driveway, Sunday mornings that don't involve an alarm clock. He's run the numbers, and at the returns, he's assuming that picture works. He's 10 years out. And there's a quiet killer in retirement math called sequence of returns risk. Here's the whole idea in one sentence. It's not just how much your investments return that matters. It's the order those returns show up in. When you're young, like Catherine, a bad decade is almost a gift. The market's on sale, you keep buying, and you've got 30 years for it to recover. But when you're Daniel, right at the finish line, about to flip from saving money to withdrawing it, a flat or negative decade is a wrecking ball. Because he's selling shares to live on at the exact moment those shares are worth the least. And once they're sold, they can't recover. The market eventually bounces back. Daniel's portfolio doesn't because the shares are already gone. We have watched this exact movie before. From the start of 2000 to the end of 2009, someone holding the S&P 500 earned over that entire decade roughly negative 1% a year. 10 years, nothing. They literally called it the lost decade. A young person dollar cost averaging through it ended up fine, even great. A Daniel who retired in 1999 and started drawing down, some of them ran out of money in their 70s. The place near the water got sold to cover expenses. Same market, same average return as the lucky generation, completely different life, decided entirely by timing he didn't control and couldn't see coming. And if you want the true nightmare version, look at Japan. In 1989, the Japanese stock market hit an all-time high. Expensive, concentrated, everyone's certain it would climb forever. It then took 34 years to get back to that level. 34. A baby born the day that market peaked could have a mortgage and a midlife crisis before it broke even. Markets do not owe you a recovery on your schedule. So if you're feeling that knot in your stomach right now, good. That's not panic. That's just you finally seeing the board clearly, probably for the first time. And honestly, this is the exact moment people ask me the question I get asked more than any other, which is, Nick, how do you have time to read all these mind-numbing bank reports and actually find this stuff? And the honest answer is that I built a little system around it, and I ended up putting the whole thing into a school community I run where I show people how I turn this kind of research into content that actually performs on YouTube, even starting from zero. The link's down in the description, and that's genuinely all I'll say about it. Back to your portfolio. Because now I owe you the other side, the way I promised. And the usual reminder here, I'm not your financial advisor. This isn't financial advice. It's just the math and a little history. So here's the honest bull case, and it is not nothing. Those Magnificent Seven companies are not the pets.com of the year 2000. They are absurdly profitable. They print real cash right now, today. Nvidia's chips aren't a promise about the future. They're sold out in the present. Pets.com sold dog food at a loss and lit a Super Bowl ad on fire to do it. Nvidia can't make the things fast enough. That is a genuinely different animal. And the argument goes that artificial intelligence could be a real productivity revolution, the kind that justifies prices that look insane by old standards. Maybe this time, the expensive companies actually grow into their price tags. It has happened before. And here's the most important piece of honesty I can give you. The people warning about valuations have been warning for years. Stocks were technically expensive in 2017 and 2019 and 2021, and anyone who sold and sat in cash missed enormous gains. The CAPE ratio is a brilliant 10-year compass and a useless next week GPS. It tells you the weather for the decade and nothing about tomorrow. Anyone who promises they know the day this turns is selling something. Nobody knows the when. We only know the setup. So what do you actually do with all this? Because the wrong answer, the one that quietly ruins people, is to panic. To get scared, sell everything and sit in cash waiting for a crash that might be 3 years and 40% of gains away. That's not protecting yourself. That's making the Dalbar mistake on purpose. Don't be the person who flinches. The real answer is quieter and more boring, which is usually how you know it's right. And the cleanest way to show it is to go back to the two people we started with, because the fix looks completely different depending on which one you are. Start with the warning itself, because it's narrower than it sounds. It was never get out of the market. It's stop being secretly all in on 7 stocks. So the move is to own more than that. There are versions of the S&P 500 where all 500 companies count equally instead of letting 7 of them run the show. There's the rest of the world international stocks, which happen to be far cheaper right now. There's good old boring value, and there are bonds which, for the first time in a long time, actually pay you something to sit there safely. Now hand that to Daniel. He doesn't need to flee the market and torch his plan. He needs to make sure a flat decade can't force him to sell at the bottom. That means spreading out of the pure mega cap bet he didn't know he'd made and holding enough in safer stuff that when the lost decade shows up, he's living off that, not selling his shares at their worst price. The place near the water survives because he stopped letting 7 companies decide whether he gets it. He doesn't have to predict the decade, he just has to make sure it can't end him. And Catherine's the lucky one. She just doesn't feel like it yet. A cheap, ugly, sideways decade right at the start of her investing life is the best gift the market can hand her, as long as she keeps buying through it and drops the fantasy that she's owed 15%. Her whole job is to not flinch while everyone else panics and quietly buy the boring stuff on sale. Keep the habit, lose the fantasy number, and let 3% today become her 7% later. Because here's what this whole thing comes down to. Wall Street didn't issue a dramatic screaming warning about a crash. That's exactly why almost nobody noticed. They issued a quiet one buried in a research note about a decade that might just underwhelm. And a quiet warning about an underwhelming decade is more dangerous than a loud one about a crash because nobody panics, nobody adjusts. Everybody just keeps assuming the next 10 years look like the last 10. Daniel keeps assuming. Catherine keeps assuming. The whole market keeps assuming. The number to remember isn't 3%. It's the gap. The gap between what you're quietly counting on and what the people who actually run the money are quietly forecasting. That gap is where unprepared retirements come from, not from a crash on the evening news, from a decade nobody warned you about loudly enough. So go look at your own account this week. Actually look. Find out what % of your supposedly diversified fund is really just 7 companies. Run your own numbers on 3% instead of 10 and see if your plan still survives it. You don't have to agree with Goldman, you just have to be ready if they happen to be right. Instead of finding out the hard way in year 9, that school community I mentioned is where I break down exactly how I dig this stuff up if you want it. I make this channel for exactly this reason, to shine a light on the quiet stuff that actually decides your money, the stories the financial news skips, because boring forecasts don't get clicks. If that's the kind of thing you'd rather be early on than late to, subscribe and turn notifications on, because the warnings that matter are almost never the loud ones. The loud risks are already priced in. It's the quiet 3% hiding in plain sight inside the fund you trusted that gets you. Don't be the last one to read the memo.